Okay, re-exploring the different types of systems for inventory. Perpetual. Look at some of the accounting transactions. Perpetual versus periodic. And again, perpetual, we're actually posting transactions into our inventory account. And we are going to be posting into our cost of goods sold accounts. These are actual accounts. When we add to inventory, we will debit inventory. When we add to cost of goods sold, recording a sale, we will debit cost of goods sold. When we subtract from inventory, we will credit inventory. Cost of goods sold, when we subtract from that, we will credit cost of goods sold. But these are actual accounts. We will be posting to these accounts. Under a periodic system, we do have an account inventory because that's a balance sheet account. But when it comes to purchases and sales and things like that, we will be posting to an account called purchases, not inventory. We post to a purchases account. So when we want to add to purchases, we debit purchases. When we want to subtract from purchases, we're going to be crediting purchases. It's actually going to be purchases, returns, and allowance, and purchases discount. And I'm avoiding that on purpose because I'm trying not to complicate things. I'm trying to keep the concepts as simple as possible. But let's take an example here of, let's say we purchase inventory. We purchase inventory. What do the transactions look like under a perpetual system? Again, a perpetual system versus periodic. Two different ways of getting to the same place. In a perpetual system, the purchase would record as a debit to inventory because inventory goes up. So I'm going to show some T accounts. Inventory is going to have a debit. And what are we going to credit? Let's say we pay cash. We're going to debit. We're going to credit cash. Notice that the inventory account has a posting to it. How would we record a purchase under a periodic system? We would not touch the inventory account. We would debit purchases. We would be debiting purchases, and we would be crediting cash. Same entry going on in cash, but it's this here where the difference lies, right there. There's the difference. Instead of debiting inventory, we're debiting purchases. So let's look at how would we record a sale. That's how we would record a purchase. How would we record a sale? Sale of goods. We sold some goods. Sold sneakers. How are we going to record that? We're going to debit accounts receivable. We're going to credit sales. But we also have to record the cost of the sale. The cost of the sale. And we're going to, because this records the sales side of it, the revenue side of it, the expense side of that transaction is going to be a debit to cost of goods sold. Remember we talked about it's a separate account here? So we're going to debit cost of goods sold. And here's the question. What are we going to credit? The answer is we're going to credit inventory. We're going to have a credit to inventory here to reduce the inventory by the costs of the goods that we've sold. Now, how would that get recorded down here under a periodic system? Very straightforward. We would debit accounts receivable. We would credit sales. And we would have nothing here. There is no transaction to record cost of goods sold under a periodic system. Is it that we don't care? Are we going to miss it? Is it going to go away and say bye-bye? The answer is no. Rather than recording it as a transaction, we calculate cost of goods sold in formula form. We take beginning inventory. We add purchases. Remember this purchases account? we add purchases to give us cost of goods available for sale. Subtract ending inventory. We actually walk the floor and do a physical inventory count to give us the cost of goods sold. We do care about cost of goods sold. It's just that we're calculating it through a formula rather than calculating it through calculating it or coming up with it through a balance in an account. There's the difference on the sales side of things. When we're recording a sale under a perpetual system, we have two entries, one to record the sale and one to record the cost of the sale. When we're recording a sale in a periodic inventory system, we only have one entry, and that is to record the sale, and it is no different than recording a sale under a perpetual system. So hopefully this will help bring in some more clarity. Now, when it comes to closing entries, like we learned about in the last chapter, chapter 4, our closing entries are going to be the same. Every temporary account gets closed out to zero through income summary. Temporary accounts that have credit balances are debited. Income summary is credited. Temporary accounts that have credit balances are all debited, and we are crediting income summary. So there is no difference, and temporary accounts are every account purchases is a temporary account. This is a new temporary account that we are now introducing. Okay, cost of goods sold is a new temporary account that we are introducing. Anything other than an asset, liability, or owner's equity account is a temporary account, and it will get closed into income summary, and then income summary will get closed into the equity account. So we're adding some temporary accounts that we will be closing, but the closing process, the procedure for closing a period is the same in the sense that all temporary accounts are zeroed out through income summary. Income summary is closed into owner's equity. Any withdrawal is closed. Any owner's equity withdrawal is closed into owner's equity. And we start fresh and new the next period with only permanent accounts that have balances. Permanent accounts are assets, liabilities, and owner's equity account. So that's it for this chapter, and we'll see you in the next video.